We're looking at a global economic landscape right now that is defined by extreme, literally almost unbelievable contradictions. On one hand, you've got markets acting like we're entering this absolute golden age of productivity, but at the exact same time, geopolitical indicators are flashing bright red everywhere you look. 7,800. Keep that number locked in your head. That is Morgan Stanley's massive new target for the S&P 500 by the end of 2026. And Goldman Sachs, they're right behind them at 7,600. I mean, these numbers represent a monumental, undeniable equity boom.
But hold on, hit the brakes for a second because here comes the visual whiplash. 2%. That is the International Monetary Fund's severe downside risk scenario for global growth. The IMF is warning us that if energy dislocations stretch out and inflation spikes, growth could plunge to 2%. That effectively puts the entire world on the absolute brink of a recession.
Okay, let's dive into this. What we're dealing with here is the 2026 macro paradox. We've got record stock highs and this relentless market optimism colliding head-on with unprecedented global risks. It's an intense tug-of-war between a superpowered profit engine and severe global fragmentation.
And you can actually see exactly how this paradox is pricing into the market. Based on the January 2026 AWS strategy report, U.S. equities are commanding a massive valuation premium to pull this off. We're looking at a towering S&P 500 PE ratio of 25.4x. To put that into perspective, that's a 23% premium against its 10-year historical average, and it's easily outpacing the Nikkei's 22.6x.
Before we unpack exactly how these opposing forces resolve, we need to pause for our standard investment disclaimer. The information provided in this explainer is for educational and informational purposes only. It does not constitute financial or investment advice. Always conduct your own research or consult a professional before making any investment decisions.
All right, back to it. Let's get into the massive pull side of this paradox. What is actually keeping these markets defying gravity right now? Well, it's the AI profit engine. This is the primary catalyst driving corporate earnings expansion straight into the teeth of some serious macro headwinds.
And the concentration of that engine is just staggering. According to Goldman Sachs, just seven major tech heavyweights, including NVIDIA, Apple, Microsoft, and Amazon, are projected to contribute a massive 46% of total earnings growth in 2026. The remaining 54%, that's left to the entire rest of the market. The productivity gains from AI adoption are the absolute secret sauce boosting the revenue of these giants right now.
Real quick, if you're finding this data breakdown helpful, go ahead and hit that subscribe button right now for more direct, data-driven macro explainers just like this one. Okay, so we've seen the engine. Now let's shift the narrative to the brakes of the global economy. This is where the fragmentation really begins, and it starts with monetary divergence. We're currently seeing uncoordinated and honestly outright opposing interest rate policies from the major global central banks. Now, what's really interesting about this is the stark contrast in global policy. It's totally striking. Over in the US, the Fed has settled into this extended pause, holding rates steady at 3.5 to 3.75%. Meanwhile, the Bank of Japan is moving in the exact opposite direction, officially raising interest rates to 0.75%. That might sound small, but that's actually their highest level in 17 years.
And this global fragmentation, it's having devastating downstream effects. Emerging markets are getting severely squeezed. When you combine elevated public debt, limited fiscal cushioning, and these diverging monetary pressures, you create a landscape where the most vulnerable populations are literally being forced to choose between buying meals and paying for rising petrol bills. And this matters to all of us because it creates fundamental instability right at the base of the global supply chain.
But, monetary policy is really just one layer of the friction. According to the Eurasia Group Top Risks 2026 report, we're facing an unprecedented convergence of political, economic, and military risks this year. These are massive geopolitical headwinds threatening the entire global architecture.
Let's look at what they rank as their #1 risk for 2026. It's the reshaping of U.S. politics and its global role. Ian Bremmer, the president of Eurasia Group, notes, and I quote, "The United States is itself unwinding its own global order. The world's most powerful country is in the throes of a political revolution."
Domestically, that political shift has resulted in some sweeping new fiscal policies. For instance, in July 2025, the One Big Beautiful Bill Act, or OBBBA, was signed into law. This legislation locks in several pro-growth and tax provisions. The key features include a permanent extension of lower tax rates for small businesses, permanent full expensing for both equipment and R&D, and temporary full expensing for new factories.
And while the U.S. restructures its policies, the rest of the Eurasia Group report lists compounding global threats that are piling up. We're looking at China potentially winning the post-carbon energy revolution, Europe's political center actively failing, and the severe downside risk of a longer, broader conflict expansion in the Middle East.
So the absolutely crucial point here is, how on earth does the market reconcile a 7,800 S&P target with a world that seems to be completely fracturing? Well, this brings us to the 2026 resolution. Let's look at the precise mechanisms that are actually allowing the global operating system to survive these unprecedented tests. Here's the secret sauce keeping the whole system running. It's essentially a two-step absorption process. Step 1. Corporate margins, which Goldman Sachs warned could face intense pressure, are being heavily protected by those massive AI productivity gains we talked about earlier. And Step 2, global supply chains are being buoyed by China's structural economic endurance, which is absorbing the brunt of these severe energy shocks.
And this brilliantly illustrates that resilience in action. During one of the most severe global energy supply disruptions in modern history, China still delivered a Q1 GDP upside surprise of 5.0%, beating the 4.8% consensus. Basically, their structural ability to withstand this shock was simply far stronger than the market anticipated.
Ultimately, AI isn't just a tech trend anymore. It is literally the 2026 operating system physically offsetting the drag of a fracturing globe, meaning the companies that control the AI profit engine now effectively control global stability. If you want to understand exactly how we got to this point, click the explainer on your screen right now to binge our full series on how the AI boom actually began. See you over there.